The S&P 500 closed the weekly candle at 7,575.39.
Right.
I mean, that is sitting just 0.5% shy of its 7,610 all-time record.
Which is wild.
It is. And the Nasdaq, it successfully defended that critical 29,237 pivot midweek. It ultimately pushed to a close of 29,825.11.
Yeah, quite the defense.
So if you are just glancing at your screens this Sunday morning, the indices look like, well, an absolute fortress.
They do on the surface, for sure.
But as we reset the deck for tomorrow morning's opening bell, the institutional strategy notes and the technical damage reports we are tracking reveal a severe underlying fragility.
Yeah, the structural plumbing is flashing warning signs everywhere.
Exactly. We are looking at a market priced for this immaculate AI supercycle, completely ignoring the macro anchor dragging right behind it. So, okay, let's unpack this.
Let's do it. Zooming out. When you analyze the internals of this tape, the concentration of capital sitting in just like a handful of mega-cap tech names is masking a massive erosion in market breadth.
A total illusion of strength.
Right. We are heading into a week packed with Tier 1 macro catalysts, and the market is facing them with an exhausted speculative buying base.
And unprecedented leverage, right. Heavily crowded onto one side of the boat.
Exactly. Highly concentrated.
We really need to contextualize the price action from last week's close, because honestly, the headline indices are actively gaslighting the broader market right now.
Yeah, that's a good way to put it.
I mean, the AI supercycle narrative is monopolizing every single ounce of institutional liquidity available.
It's sucking the oxygen out of the room.
Completely. Look at Meta. They release a structural update regarding a massive 14-gigawatt AI compute expansion, and the stock rips 15% in 5 sessions.
It's just incredible volume there.
And NVIDIA tacks on another 4% without even breaking a sweat.
Right, and don't forget the ultimate validation for the hardware thesis.
SK Hynix.
Yeah, SK Hynix executing that historic $26.5 billion U.S. debut.
Which popped, what, 13.1%?
Yeah, 13.1% to finish Friday at 168.50. The demand for high bandwidth memory is clearly insatiable right now.
Absolutely insatiable.
And the market is rewarding that specific hardware thesis with massive premiums. But, and this is key zooming out to the weekly time frame, reveals the real cost of that concentration.
Right, because the rest of the market is paying for it.
Exactly. The mega-cap tech stocks aren't just outperforming, they are acting like a massive canopy tree in a rainforest.
Oh, I like that analogy.
Right. They're absorbing all the institutional liquidity, all the sunlight, leaving the small and mid-caps completely starved in the shade.
Yeah, just dying on the forest floor down there.
Basically. The danger isn't simply that the small caps are underperforming. It's that if the canopy takes a hit, the underlying ecosystem has no root system left to hold the soil together.
Which we saw clearly with the Russell 2000.
Yep.
It actually bled out 0.59% this week to finish in the red.
While the S&P is basically at record highs. It's crazy.
And the Dow Jones Industrial Average dropped 0.41% to 52,637.01. That snapped a solid 4-week uptrend.
Yeah, that breadth divergence is the glaring tell for anyone really watching the tape.
Because a sustainable breakout past that 7,610 level on the S&P mathematically requires participation down the market cap ladder, right?
You need broad support. You can't just rely on 3 stocks.
But instead, the institutional volume profiles show big money just sitting on the sidelines.
Yeah, letting passive inflows push the mega caps up.
While they're actively reducing exposure to industrials and financials.
Which forces a really hard examination of what actually drove the S&P's massive 15.2% advance in the second quarter.
Right. Because if broad institutional participation was absent, what fueled it?
Well, the CFTC Commitment of Traders report provides the mechanical autopsy of that rally.
The COT data.
Yeah, the COT data. Back in early June, the speculative community was aggressively positioned for a pullback. They were holding 221,000 net short contracts on the S&P 500.
A massive short position.
Massive. But heading into tomorrow morning, that short base has been vaporized down to just 38,000 contracts.
Wow.
Leaving a net position of minus 42.9K. We are currently sitting at a 52-week low for speculative shorts.
Wait, let me play devil's advocate here.
Sure.
A low short base usually implies bullish conviction, right? Like, why look at a lack of shorts as a structural vulnerability?
I get that logic, but
isn't it just a market that has finally capitulated and bought into the AI earnings multiples? I mean, if the bears are cleared out, shouldn't the path of least resistance be higher?
You would think so, but it comes down to the mechanics of order flow and margin requirements.
Okay, walk me through that.
So those 221,000 short contracts, They represented future guaranteed buy orders.
Right, because to close a short, you have to buy the stock.
Exactly. As the AI megacaps dragged the cap-weighted indices higher throughout June, those short positions went offside.
They started losing money.
Right. Margin parameters were breached, and that triggered forced passive buying to close out those trades.
Okay.
That mechanical short covering is what provided the torque for the 15.2% run.
So it wasn't actual bullishness?
No, it wasn't organic, fundamental accumulation by large institutions. It was a liquidation cascade on the upside.
So the fuel for that specific rally has been completely consumed. The forced buying is exhausted.
Yep, the market has reached a state of mechanical exhaustion. And when you lack a significant short base, you also lack a structural floor.
Because there's no one left to buy the dip.
Exactly. In a sudden macro downturn, short sellers naturally take their profits by buying to cover.
Which inherently cushions the velocity of the drop.
Right. It provides a passive bid. But without those trapped bears, a sudden macro shock encounters an absolute vacuum of buy limits on the way down.
The liquidity just disappears.
It just vanishes.
Okay, so if the speculative squeeze is entirely exhausted in equities, that leveraged capital didn't just evaporate from the system, right?
No, it definitely went somewhere.
Looking at the latest positioning data, it is abundantly clear that capital flowed directly into the macro space.
Heavy crowding there.
We are seeing extreme historic crowding in the currency and rates markets. U.S. dollar speculative longs just hit a 10-year high of $39.8 billion.
Which is a huge structural bet.
Concurrently, the VIX is tightly pinned at the 15 to 16 level.
Yeah, and that's due to aggressive short volatility positioning. Funds are heavily shorting volatility premiums.
They are banking on this low realized volatility regime persisting indefinitely.
Right, they are implicitly shorting the possibility of tail risks, basically assuming the current market structure is permanent.
But the most alarming concentration of leverage flagged in these institutional notes is in the rates market.
Yeah, this is the really scary part.
We are looking at a record $750 billion notional short position on SOFR, spread across 3.12 million contracts.
That's massive.
With SOFR shorts hitting 3.12 million contracts, we aren't just looking at standard hedging for corporate debt issuance here, right?
Oh, no, definitely not.
Leveraged funds are weaponizing this position. They are betting massively against a dovish pivot from the Federal Reserve.
Exactly. They are locking in a structural view that the Fed's terminal rate will stay higher for longer.
Which suppresses the long end of the curve. So how does that crowding complicate the equity picture we just discussed?
Well, it creates a systemic unwind risk.
Okay.
When $750 billion is crammed onto one side of the macro boat.
Expecting inflation to remain sticky.
Right, expecting rates to stay elevated and the dollar to remain dominant. Any deviation in the incoming data forces a violent repositioning.
Because a position of that magnitude cannot be unwound gracefully.
Never. If the macro data shifts, these funds will face massive margin calls on their rate bets.
And to meet those calls,
they are forced to liquidate their most liquid holdings, which invariably means dumping their large-cap tech equities.
Oh, wow. So the crowding in SOFR is effectively a hidden tax on the equity market stability.
That's exactly what it is.
That sets up the collision course for this week.
It really does.
We have the AI equity narrative operating in a low-volume vacuum, completely insulated from the macro reality.
While the macro reality is a coiled spring of leverage, just waiting for a catalyst.
And that catalyst is hitting the tape on Tuesday.
Yeah, the macro theme driving this market right now is the friction between slowing growth and sticky inflation.
And the calendar is packed with red folder events.
Starting with the geopolitical friction that is keeping a rigid floor under inflation.
Right. The crumbled ceasefire in the Middle East and the escalating tensions with Iran.
Yeah, that's anchored WTI crude oil at $71.59 barrel.
And that energy premium bleeds directly into transport and production costs.
It complicates the inflation data before it even prints.
Meanwhile, the 10-year Treasury yield is creeping up to 4.568%.
Signaling that the bond market is already rejecting the idea of imminent aggressive rate cuts.
So Tuesday morning resets the deck. We get the June CPI print before the bell.
That's the big one.
The headline number is modeling just under 4%. But the whisper numbers on core CPI have it incredibly sticky at 2.9%.
That 2.9% level is so stubborn.
Simultaneously, we have Q2 bank earnings kicking off. JPMorgan Chase, Citigroup, and Wells Fargo.
And the market will be parsing those loan loss provisions and credit card delinquency rates.
trying to gauge if this high-rate environment is finally breaking the consumer.
Right.
And as the third pillar of this triple threat Tuesday, we have Fed Chair Kevin Warsh testifying before Congress.
Yeah, and Warsh leaned heavily hawkish during his last appearance in June.
He essentially demanded structural evidence of disinflation before entertaining a cut.
But the data landscape is shifting rapidly beneath him. It's creating an incredibly complex dual mandate conflict.
The friction here is undeniable. The macro anchor is getting significantly heavier.
Especially with the labor data.
Exactly. We just saw a dismal June jobs report. It printed a net add of just 57,000 jobs against a consensus expectation of 110,000.
The labor market is decelerating rapidly.
So Warsh is effectively trapped.
He is completely boxed in.
He has a labor market flashing early recessionary signals, but core inflation refuses to break below that 2.9% threshold.
Right. He cannot cut rates to save the labor market if CPI prints hot on Tuesday.
Because that would destroy the Fed's credibility on inflation.
Exactly. It's the ultimate bind.
So if the Federal Reserve is going to initiate a rate cut cycle at their July 29th policy meeting, they absolutely require this upcoming Tuesday CPI data to cooperate.
They need a cool print. The institutional notes actually map out two highly asymmetrical pain trades for the week ahead based on this exact tension.
Okay, let's execute the game plan and map the fallout for you listening, starting with the upside pain trade.
The Goldilocks scenario.
Right. Assume Tuesday's CPI prints cool. Let's say core comes in at 2.7%.
Okay.
Inflation is receding faster than expected, but the bank earnings show the consumer is bending, not breaking. The market interprets this as the green light for Warsh to pivot.
Mechanically, that triggers what the street is calling the great rate squeeze.
Oh, because of all those shorts.
Exactly. The funds holding that $750 billion SOFR short position are instantly underwater.
Right, caught totally offside.
Yep. To hedge their massive exposure and stop the bleeding, they will be forced into panic buying treasury bonds.
And this tidal wave of forced accumulation causes treasury yields to collapse.
It's a textbook squeeze.
And a collapse in yields immediately re-rates the sectors that have been suffocated by the high cost of capital.
It triggers a massive rotation play.
Capital floods out of the crowded megacaps and cascades into the Russell 2000.
And rate-sensitive proxies, like the real estate sector.
The XLRE ETF.
Yeah, we would see a historic, face-ripping rally in small caps, while the tech canopy just sits there.
Completely starved of fresh momentum.
Yep. But the downside risk, the stagflation trap, is far more systemic and violent.
Okay, walk us through the mechanics of that. Let's say CPI comes in hot at 3.1% core.
Which proves inflation is reaccelerating.
And then Thursday's retail sales data prints negative.
Confirming the consumer has finally tapped out.
Right. The Fed is totally boxed in, the economy is stalling, but the inflation mandate prohibits a rate cut.
That completely vaporizes the soft landing narrative.
So how does the market structure physically break down in that scenario?
Well, the immediate casualty is the volatility market.
The VIX.
Exactly. All those funds heavily shorting the VIX, banking on perpetual calm, they face an instant margin crisis as the VIX spikes violently from that pinned 15 level.
And to dynamically hedge their exploding short volatility portfolios?
They are mathematically forced to short S&P 500 futures.
Oh, wow. And this loops us directly back to the COT data we analyzed earlier.
It's all connected.
When they aggressively short the S&P to hedge their volatility exposure, they are hitting a market with an empty gas tank.
Yep. There is no existing short base to buy to cover.
There's no passive bid to absorb that selling pressure.
The liquidity just evaporates. High valuation growth equities get repriced violently lower as the 10-year yield spikes above 4.6% on the hot inflation data.
So consumer discretionary stocks, the XLY ETF, take a massive beating as the stagflation reality sets in.
Yeah, because of the self-fulfilling cascade of technical selling, it entirely ignores fundamental valuations or AI growth projections.
So as an active participant, you need to track two specific levels this week to gauge which regime is taking control of the tape.
Very important levels.
On the S&P 500, the ultimate line in the sand is 7,480.
If the market breaches that support with expanding volume, the downside vacuum is in play.
And for the bond market, keep your eyes on the 10-year Treasury yield at 4.55%.
A sustained break above that level guarantees heavy gravitational pressure on equity multiples across the board.
The directive from these strategy notes is very clear. Do not chase extended tech plays before Tuesday's CPI print.
Stay heavy on liquid, high-volume leaders.
And keep cash ready to deploy on any macro-driven volatility.
Capital preservation is paramount when the underlying structure is this heavily leveraged. You want the liquidity to take advantage of the forced unwinds, rather than being the one forced to liquidate.
Exactly. But before we wrap this Sunday morning prep, there is one final unmodeled variable to consider for you guys listening.
A wild card.
Right. A thread to pull on that isn't explicitly mapped in the macro damage reports. We have framed this entire week around the macro anchor inflation, Kevin Warsh, CPI, and the Fed.
Usual suspects.
But what if the ultimate ceiling on the AI supercycle isn't monetary policy at all?
Oh, the physical constraints.
Yes. Let's look back at Meta's 14-gigawatt compute expansion. 14 gigawatts is the power equivalent of multiple nuclear reactors.
It's a staggering amount of energy.
We are modeling exponential growth in data center buildouts while operating on an electrical grid engineered for the 1970s.
Yeah, the math doesn't quite work.
What happens when the structural bottleneck isn't the cost of capital, but the physical limits of energy generation?
If the grid physically cannot transmit the wattage required to power this hardware.
That is a hard cap on growth that no amount of rate cuts can solve.
Right.
We might be obsessing over the financial plumbing while completely ignoring the physical plumbing.
That introduces a massive structural vulnerability to the long-term thesis. I mean, if energy infrastructure cannot scale concurrently with compute demands, the hardware projections hit a literal wall.
It fundamentally reframes the vulnerability of the entire tech rally.
Absolutely.
So it is something to factor into your thesis as you watch the order flow tomorrow morning. The tape might look smooth on the surface, but it pays to know the exact thickness of the ice before you commit your capital.
No said.
Thank you for joining us on this deep dive. Keep questioning the headlines, respect the macro volatility, and we'll catch you next time.